we're to put our longer term thinking caps on, is there a particular trend or a thematic that you think will be really important for investors to get right over the longer term?
I think one of the things we've been discovering over the last couple of years is how profoundly different some software company business models can be, and these winner-take-all markets where they have very low asset intensity, very low cost bases, high margins, and an ability to grow their revenues at this extraordinary rate and create new markets where there were none before. These are really kind of strange beasts from an economic point of view. Now, the market has priced these very fulsomely. So I think over the next couple of years, there's going to be this real tension between, these companies might continue to capture the lion's share of the profits available out there, but then how much of that is already reflected in pricing? Because if you go back to 1999, even if then you'd been an amazing stock picker and you'd figured out that Microsoft, Amazon, Google, that those ones are going to be the winner, and pets.com were going to blow up, you still had to wait, 16 years to get back to the previous peaks. So, you can have an amazing company that's a long-term winner that still can have some very big gyrations in the valuation the market will put on it.
Climate change is a critical issue. I think if we could try and perhaps refocus it away from the term climate change to health, I think that's a better way of looking at it. And so if we can come to grips with those consequences, that to me will lead to much better outcomes all round.
The last 40 years, bond yields have actually been falling for the last 40 years, and we've reached a point probably where they can't go much lower. So over the next decade, we're thinking about, well, where could interest rates get to, especially when you have monetary policy makers and fiscal policy makers, especially in the US and Australia, very much intent on creating inflation. And that's what we're seeing. So it's not just, monetary policy cannot do much more from here, but now the governments are taking over and they're really, really spending. So, the stimulus that was injected into the global economy to offset COVID was 15% of global GDP. That's $20 trillion across the globe that's been pumped into the system. So there's very much an intention, and you can see from what the Treasurer says, that they want to create inflation, in particular, wages inflation. Now, all policymakers will say, well, yeah, we like a little bit of inflation. Everyone likes a little bit of inflation. The question is, will it be a little bit of inflation, or will it be something that gets out of control? We don't know that, but I think getting that question or thinking about that over the next decade is quite important.
The most exciting thematic that is beginning to play out and has a long way to go is the rise and rise and rise of iGaming and e-gaming and esports. And that phenomena, and we're talking about online betting and gaming, and we're talking about it in the case of the United States, where essentially betting and gambling was essentially prohibited outside the government tote. It was prohibited for 100 years. So you had the passing of legislation there, which is state by state going to open up wagering and gaming across the United States. We've already got a substantial market in global video gaming as well. The global video gaming, we're talking about Nintendo games and Activision Blizzard and Take-Two and those sorts of businesses. That market's already worth something like $31 billion. It looks to me very much like iGaming and esports. That market will dwarf that in size. I think the estimates in the US of iGaming did have the total revenue available to companies of something like 25 to 30 billion. It looks like that pool of potential gambleable dollars, if that's the word, or puntable dollars, is probably closer to $40 billion. So there's an enormous opportunity that goes with this online, the rise and rise of online commerce.
From my perspective, risk-free real returns are dead. I think we've gone are the days when people could sit in risk-free or close to risk-free assets like cash and term deposits and generate some sort of real return, so a return on top of whatever the inflation rate is. At the moment, that's deeply negative, and even when central banks, I think, go through the next cycle of lifting interest rates, it'll get back to somewhere around zero. So if you're an investor sitting there and you require a real return, a real income stream, you have to start to think to yourself, what risks am I happy to assume? Because if you sit as I said, sit in riskless term deposits and cash, then the chances are, the probability is that over time, actually your capital after inflation is going to go backwards. So you have to ask yourself, it's going to be a different answer for each individual investor. Do you take some term or maturity risk? Are you happy with credit risk? You're happy to put more equity risk into your portfolio. So I think the answer is different for everyone, but if you're not asking that question, and it depends on the initial conditions of your portfolio, then I think you're taking a real risk looking forward from here.
Investors need to recalibrate their expectations. So we're at a point now where from the bottom, we're talking markets up 70 or 80%. There's not many places you would have put your money that would have lost you money over the past 12 months because everything almost went up unanimously in synchronization. So I think that to get it right, and this really aligns to how we think about investing, is you want to think about which businesses truly will succeed over the next 2 to 3 years. And one test it's very simple, one test that we use is we think in the terms of if the market's closed today and you couldn't trade anything for the next 3, 5, 7 years, what would you want to own now that would be worth the most on the other side of that?
Some of the things which I think are now starting to, become important are, I think this sort of broader idea of rebalancing, and we're seeing it in terms of sort of geopolitics, US, China, and how and where that plays out. We sort of moving into a world of deglobalisation, which could be problematic for inflation and a kind of a realignment of sort of the geopolitical power alignment. And I think the inequality story is playing out as well, and that's I think likely to flow through into sort of policy settings and so on, in terms of sort of taxation and so forth. So I think there's this very positive short-term story, but I think there's a number of sort of fairly powerful longer-term sort of structural thematics that I think will have a big impact over the next decade.
The rising bond yield is going to have an impact, right, in terms of as we move back to normalcy, right? There has to be an impact on what the multiples and what happens to multiples. The question is, can earnings, earnings growth make up for that contraction in multiple? And we're already starting to see it in the market because we've got this positive earnings revision coming through, plus the multiples are contracting as those earnings are rising. So I do think it's really back to that inflation argument, rising interest rates, and that is going to be one area that you have to really grapple with over the next 10 years.